Morning, by the way. Happy
Good
Christmas,
morning.
everyone.
Sorry, I've already said hello, so I forgot that we hadn't that on air. Good morning, Kamal Sharma.
Good morning, Steve. Well, look, this week has been very much dominated by two big events. The Fed, and obviously this evolving news about the potential shutdown. You mentioned earlier before I came on air about dollar exceptionalism. We are very much in this dollar exceptionalism environment. The Bank of Japan and the Fed have effectively bookended central banks this week. We've had a dovish tilt from the BOJ, Bank of England, as you quite rightly mentioned, and then the Fed have effectively gone all in on a hawkish outlook for next year. So they've removed a couple of cuts, pretty much in line with our expectations.
It's still getting to the same rate though in 2027. Still 3.125 by the end of this cycle.
Yeah. Again, the question is, how do we get there? The markets now are expecting another 50 basis points of rate cuts. The question is, given the data that you've just mentioned, is there a point at which the market starts saying, do they actually have to hike in between? And that's going to be...
It's the point I'm trying to make to our viewers. Then the stock market fell so aggressively on the back of this perceived hawkishness. I didn't think it was that hawkish. I thought it was quite realistic given everything you said. I didn't know what cognitive dissonance was going on elsewhere. That's a good thing for the US economy when they're growing better than expected, when they're losing less jobs, when the consumer is such a dominant factor, when a consumer represents 2.5% of 3% of GDP growth in the third quarter. It's a good thing.
But it's frothiness, right? It's about the valuation in the equity markets. We have come a very, very long way this year. And I think that's part of it. We're coming up to the end of the year, as you said, and that probably has persuaded some investors to take some risk off the table, reload into 2025. But historically, what you have seen is when you have a hawkish central bank, be it the Fed, be it the Bank of England, you tend to get yields higher, equities lower. It's a kind of a typical reaction that we're seeing. Nonetheless, the outlook next year, I think, is going to be a lot less certain. If you notice, all the central banks yesterday and this week have probably overemphasized that one word: uncertainty, uncertainty, uncertainty.
And how would you balance that? I'm just looking at the U.S. dollar index rising to a two-year high of 108.50. So as you pointed out correctly, there's currently positioning when it comes to the exceptionalism when it comes to U.S. equities, but also the U.S. dollar. But then you've got all this uncertainty when it comes to Trump policies, when it comes to the shutdown, when it comes to some of the inflationary policies, and what that could do to growth. So what's your medium-term outlook here on the dollar? Or is it too hard to say right now?
I think, look, we've published a set of year-ahead reports earlier at the end of last month, and the basic conclusion here is that we expect this dollar exceptionalism to last at least into the first half of next year. As you said, we're actually trading in an environment where we are expecting the perfect storm. Okay, so you're saying tariffs are coming. This is going to be bad for the rest of the world. The dollar smile should help dollar exceptionalism. Looking further beyond, does trade uncertainty then materialize into actual further dollar gains? We don't think so. We're looking for a kind of a reversal in dollar strength towards the end of the year, so 110 in euro dollar, for example. Yes, and that will probably be on the basis that, yes, there will be some of this frothiness taken out of the market. You know, we've got the whole story about government shutdowns. We're worried about the US fiscal situation, and I think that's going to come into sharper focus in 2025.
We know that Trump wants a weaker dollar, essentially. What we also know is that he has warned the BRIC countries against setting up a BRIC currency. What do you make of the whole debate about de-dollarization? Is there any credence, anything of importance here?
Well, this has been, admittedly, this has been quite a strong theme amongst our investors, and we've been talking about this for a few years now. De-dollarization has been going on, but at a very, very slow pace. Now, the key question is, what is the alternative? How do you move away from the dollar to a broader bifurcation of currencies? We don't see that happening. Admittedly, if you look at the latest IMF data on reserve currencies, the share of dollar as a reserve currency has fallen, but it's not gone to the benefit of other currencies. What is the asset of choice? It's gold. You see a lot of central bank buying of gold at the moment, so that's the asset diversification. Will we see de-dollarization next year? We don't think so. We think it's more of a stealth move. It will happen at a very, very slow pace. but we're not concerned about the dollar being usurped as a reserve currency.
I've got